Hello and welcome. You're watching All About Your Company. I am Snehi Shah, and today in focus is a very special company from the healthcare space, and we are going to be interacting with the management of Rainbow Children's Hospital or Rainbow Children's Medicare. Before we interact with the management, here's what we are aiming to get from this conversation. What we want to know is if there's going to be any strategy, a change down the road, because they've had a new CEO appointment as recent as January of this year. Has their average revenue per operating bed, the ARPOB metric, has that maxed out or has that peaked out, given that there has been such solid growth on that front? When will the top line growth, in fact, if the top line growth is going to be sustaining in teens, we've seen a 12% top line growth in the most recent numbers in Q3. If that trajectory is going to be sustainable is going to be important to see. On the margin front, will we be seeing margins cross that 35% mark? They've historically been between 29 and 33 in the recent past. So is there a possibility of margins crossing 35? What's the upside there? We'll be talking to the management about this as well. Other than this, what is the balance going to be between further new expansions versus improving the existing operational efficiencies in the existing hospitals? Where is the focus going to lie? What's the tilt there? This is also going to be part of the conversation today. And we'll also be understanding the timeline for the maturity of new hospitals. More importantly, the ARPOB figure between the new and the mature hospitals. When is that divergence going to reduce between both of them is going to be on our radar as well. And lastly, most importantly, the occupancy figure. Is that number going to be lower than 60 going ahead permanently as they expand the more number of hospitals? This is also going to be a part of our conversation. So while we are going to be covering all of this, it's time now to delve deeper into the operations, into the financials of Rainbow Children's Hospital. So here's all about that company. Let's start by looking at what the company does. The company is a multi-specialty pediatric, obstetrics and gynecology hospital chain, operates in the south of India majority with 22 hospitals and 5 clinics across 9 cities. Total bed capacity is at 2,375 as of the latest number, and it offers a wide range of services. It is the country's largest pediatric hospital chain. Let's talk about some of the services that it offers. It ranges from newborn to pediatric intensive care, pediatric multi-specialty services, pediatric quaternary care, obstetrics, as well as gynecology. These are some of the services that this hospital offers. Now let's talk about the operations and how geographically spread this company is. It's got multiple hospitals in Hyderabad, Bengaluru, also got operations in Chennai, Visakhapatnam, Delhi, Guwahati. So widespread, but most of its operations are centralized, or they are concentrated in Hyderabad and Bangalore. Now, let's understand the operating model of the company, how the company operates. It follows a hub and spoke model in South India. What is this model? Basically, there is a hub hospital and then there are spoke hospitals within 200 to 250 kilometers from the main city hub hospital. Hub hospitals have 150 to 250 beds, and there are 1 to 2 hubs per each metro or per each city. And the spoke hospitals that are 200 to 250 kilometers away have anywhere between 50 and 100 beds. There are 5 to 8 spokes around a hub, and whenever there is a complex case at a hub, at a spoke, it gets referred to the hub hospital. This in a nutshell is what the operating model of this company is. Now let's talk about the numbers. Let's talk about the 9-month financials of the company. 9-month FY26 numbers compared to FY25. The revenue has seen an uptick of 9%. It's coming at 1,243 crore rupees. The EBITDA, which looks really solid, has seen an uptick of 7%. It's coming at 400 crores versus 375 crores. The margins have seen a little bit, a very nominal correction on the year-on-year basis. When you talk about 9 months FY26, it's coming at 32.2% compared to 32.8%. And on the bottom line, there's been an expansion of about 9%. The net profit for 9 months FY26 has come in at 204 compared to 188 crore rupees in the same time last year. This in a nutshell is what the company is and what the company does, with a very brief overview of its financials. Now let's delve deeper into the operating metrics of the company. First, let's start by talking about the margins. The margin trajectory has been more or less stable for the company, ranging anywhere between 29.5% and 33%. In fact, for Q3 FY26, which is the latest number, it's at 33%, and it's been very stable, as you can see, on the margin front. So margins are looking solid, and now the question lies that if the margin growth has been so solid and so stable, Is there any room for further upside over here? This is something that we are going to be interacting with the management about. Now let's delve deeper into some more operating metrics, and let's start by talking about the ARPOB, which is the average revenue per occupied bed. In FY23, this number was at 48,932 rupees. Now it's come all the way up to 58,362, which saw a sharp spike above that 60,000 mark in Q1, and from there we've come back to 58,000 thereabouts for Q3. So very solid ARPOB growth, and what is very interesting is that this is the hospital that has the highest ARPOB growth across any listed hospitals in the Indian markets. So yes, a very strong move coming in on the ARPOB front for Rainbow Children's Hospital. Let's move away to another metric. Let's talk about the ALOS, or the average length of stay. This has also been very steady and very stable over the years from FY23 all the way up to the recent Q3 FY26 numbers. It's ranged anywhere between 2.6 and 2.8, with the latest number being at 2.7 days. So this metric has been very solid and steady over the test of time as well. Let's also look at what the occupancy is shaping up to be. What started at 55.4% in FY23 has taken a little bit of a knock when you talk about the most recent numbers in Q3. The occupancy is at 47.2, but largely this is what the trajectory has been. Yes, a little slip was seen in Q1 when the number came around just 40%. So we'll try and understand on this more about this from the management as well. But this is largely what the occupancy picture is like, currently below the 50% mark, at least for Q3. Now let's talk about the mature hospitals and the new hospitals. So the capacity beds in the mature hospitals are at 1,371 beds. For new hospitals, this is at 914. The occupancy, this is where the real divergence is, and this is what we were talking about earlier, what we aim to understand from the management, that when this divergence is looking to narrow, occupancy for mature hospitals is at 52.6% compared to just 38.8% for the newer hospitals. So this is something to watch out for. And of course the ARPOB figure is at 60,319 for the mature hospitals, and it's just around that 50,000 rupee mark for the newer hospitals. So the growth trajectory here and the outlook going ahead is also going to be very important to see. While we've spoken about the operational metrics, let's now talk about the balance sheet and what this picture is shaping up to be. On the equity investment front, this is at 102 crores. That has been very steady over the years. In terms of the other equity, which is a mix of your profit and reserves, it's continued to plow back into the company. The company has kept increasing the share that it's putting back for expansion and internal development. This number has come in at 1,416 for the first half of FY26. On the back of that, there has been a steady increase in the book value as well. Total book value as of now at 1,518 crore rupees. So that also looks very good. What really stands out is the borrowing number, which is a big fat zero across the board, because this company is largely a net debt-free company, and that is something that works in the favor of the company as well. And if you talk about the cash and bank, well, yes, that number is at 27 crores for the first half of FY26. That is the kind of trend that the cash and bank has also seen. But yes, what really stands out is the net debt-free number, zero debt for the company, and that is a big positive. Let's talk about some ratios and let's talk about returns. The return on capital invested, the ROS number, is at 19% for FY25. That has significantly come down from FY23, where the number was at 24% after going up from 23 in the previous financial year. But yes, seen a little bit of a moderation in FY24 and FY25, where the number is at 19% now. While we've understood the broad structure, let's now take a look at this from the investor standpoint, and what is the shareholding looking like. Promoter shareholding continues to be very strong and stable, giving it confidence from the promoters' end. It's a 50% holding from the promoters. There's deep interest coming in from FIIs and DIIs too. Up until March 25, FIIs held about a 24% stake, which was then trimmed by 5%, and as of December 25, the stake came down to 19%. But this stake was lapped up by DIIs, because if you take a look at what the DII shareholding has been like, it's gone up from 15% to 19% over the period of March to December of 2025. So that is what the FII-DII holding also looks like. The public shareholding is at 11%. Number of shareholders have also steadily increased. Very quickly taking a look at what the analyst recommendations have been. 14 analysts track this stock, 13 of them have a buy rating, 1 has a hold rating, and the average return potential over here is flagged off at 32% on the upside, so also another big thumbs up for the company. Lastly, coming to the most important part, let's talk about valuations. The valuation on a 1-year forward basis is 37 times. The 2-year range is between 35 and 56 times, which brings the 2-year average to 45 times. If you stack this up versus its other listed players, this is somewhere in the middle with 37 times. You have Aster DM and Max Healthcare that are at 58 and 52 times, and you have Narayana and Yatharth below this, or slightly cheaper than Rainbow Children, because they are trading at a valuation of 35 times and 29 times respectively. That sums up everything that you need to know about this company. Time to slip into a very short break. On the other side of the break, we'll be interacting with Mr. Ramesh Kancharla, the CMD at Rainbow Children's Hospital, who will give us an understanding of everything that we aim to seek answers for. Time for a quick break, and we'll be right back. Back with all about your company. The company in focus today is Rainbow Children's Hospital, and we now have the management, Dr. Ramesh Kancharla, who's the CMD of the company. He's joined us to take us through some of the key questions that we have about the company. Dr. Kancharla, good afternoon, and thank you so much for your time. First, let's start by talking about your growth plan. The hospitals, the new hospitals that you have been expanding, bring us up to speed in terms of what is happening with the hospitals that are under construction. What is the timeline, and how quickly will these hospitals start contributing to the overall financials?
Yeah, thank you very much. So we have added almost 3 hospitals in the last few months' time. Now, as we look forward, I think we have a kind of almost 425 beds in Gurgaon going to come in next 24 months' time, and Pune another 150 beds. Coimbatore is about 130 beds. So these are the ones which are in pipeline. We're just going to commence operations one spoke hospital in Bangalore. So we have collectively added about 780 beds in the last 2 years' time. So that's all the new beds which are for the growth for the next 1 to 2 years' time.
Okay, and Dr. Kancharla, talk to us about the occupancy. This is something, these numbers, the kind of occupancy trend that we've seen. Your occupancy is at 47.2%. It slipped below 50. First of all, what is the outlook on occupancy going ahead? And more importantly, the difference that we're seeing, or the divergence that we're seeing in occupancies between your mature hospitals versus the newer ones. When do you see this occupancy gap narrowing?
Yeah, say our hospital's occupancies, I mean, we can't compare ourselves to the multi-specialty hospital. And you should see ourselves as kind of we don't do any government businesses like CGHS, state-run health scheme programs, ESIs, any of those things. The pure play of kind of a private hospital with a insurance as well as cash segment. So as a women and children's hospitals, always the occupancy, we don't have a chronic diseases and there's seasonal variations. So if you look at our past, we kind of, when we had a 55% of occupancy at the blended level, we have actually delivered every single number. So that's what happens to us. And also we have a differential areas of the beds within the hospital, like some isolation beds, 17% of the beds are newborn intensive care. So we can't utilize for any other purposes. So that is the reason. And on top of it, we constantly expanding. As I said, we've added 780 new beds. So it's we talk about blended occupancy. When you look at the occupancies which are matured hospitals, which versus new hospitals, obviously there is difference there. Of course, the current financial year, which is the last 3 quarters, our occupancies have been low compared to the last year. That's because of there is a muted seasonal, muted season with all the seasonal illnesses being low and vector-borne diseases being low. So that's what we have seen. Generally, if we do a 55% occupancy at blended, we will deliver every single number. I mean, whatever is we budget, we expect it. That's how our business is like. We have a low ALOS business and shorter stays and more of acute problems and also the obstetrics is again the low ALRs. This is how we see our business.
Right, Dr. Kanchala, so you did mention that 55% occupancy is something that you're looking at. On the back of this number, talk to us about how this shapes up your ARPOB going ahead. What is that number going to look like? And is there a way that number could spruce up once again above that 60,000 mark?
So our RPOPs have been pretty impressive so far. I think again our RPOPs are good because of two reasons. One is because of low ARRs. Second is because of the uh, one is because of low ALRs. Second is we do a lot of intensive care and also a very high outpatient revenue. So that's why our RPOP stays higher. And we have been, the trajectory is going to be like this. And the RPOP is not going to be a kind of a metric which actually it varies from quarter to quarter. When you have a lot of seasonal business, your RPOP may go down, but your revenue generation will be good and your EBITDA will be impressive. So we can't just go on chasing RPOPs. What we see is ARPP, average revenue per patient, is probably more important. That we grow by 5 to 6% year on year.
Okay, so that's a 5 to 6% here on your growth, if I've heard that right, on your ARPP metric, Dr. Kanchala?
That's right.
Okay, so that sounds positive going ahead. Also talk to us about what the plan is between the newer expansion hospitals that you are chalking out right now. By when are we looking at seeing maturity of some of those hospitals? And we've spoken about by when they can contribute to the top line, but talk to us about your geographical expansion. Are there any plans to diversify into newer geographies where you are not currently present?
Yeah. So maturity of the hospitals usually will take about 3 years to kind of break even if we are doing hub hospitals in a new geography. And also the hospitals wherever we do our existence, like Hyderabad, and we probably kind of a break even in the first year. And Bangalore, when you go, it probably takes about 15 to 18 months time. When you go as a large hub in a completely new area, it would of course take about 2.5 to 3 years time. That's how it is. The important thing is that we do break even at lower occupancies. That's because of again shorter ARRs and also a lot of outpatients and the quality business. So we don't do any government business.
Okay, and Dr. Ramesh, what I want to understand is this cash flow from operations to EBITDA currently is at 80%. So there is a very strong conversion of your EBITDA to cash flows. Talk to us about what is the outlook on cash flows. How much of that is going to be retained for, let's say, investment into the business and more expansion, and how much of that is going to be put aside?
I think how we look at it is a blended. We see we always look at our balance sheet and also what is the cash on the balance sheet. We've always been kind of having a strong cash on the balance sheet. Right now we have about 570 crores on the balance sheet, and which is good for all our expansions. Year on year, I would say that now we add about 250 to 300 crores to the balance sheet. So our outflow would probably be around 300 to plus maintenance capex will be other crores. So I think we when it comes to cash position, also kind of capex for new hospitals as well as maintenance capex, we'll still be positive as we move forward with all the beds coming up in Gurgaon and Pune as well as Coimbatore.
Okay, and Dr. Kanchala, lastly, if you could just talk to us about the valuations bit. The hospital is currently valued at 37 times. I'm just trying to understand the kind of trajectory that you have on the top line and the bottom line. What could that do to the valuations going ahead? And lastly, if you could just give us the outlook on the financials and we'll figure the valuations part out of it.
I'm not a person to give the valuation forecast. That's up to the markets and shareholders. But what I could say is that so we are in a niche segment, and we are the largest children's hospital group, and we are very focused. and we build a lot of strength within our children's hospitals. We do a right from primary care to secondary care, tertiary care, and also the quaternary care. So this is how we're going to be geographically as we expand. For example, in Hyderabad, there are about close to 1,000 beds. We have opportunities to do more beds in Hyderabad. The Bangalore, I would say we continue to kind of build our more bed capacity in Bangalore and Andhra Pradesh as well. And Chennai, we are expanding to Coimbatore. So next future, we would look at kind of NCR, Delhi is going to be a large space to kind of expand ourselves. More than adding beds, very important for us is to kind of build the breadth and depth of the children's health care to do advanced care for children and specialty care for children and quaternary care for children.
Okay, Dr. Kanchala, on that note, we'll let you go. Thank you so much for taking the time out, joining us on All About Your Company and giving us a deep dive about your company. With that, viewers, just to very quickly sum it up, no debt on the balance sheet, a big thumbs up, cash flow conversion is good, return ratios are above 15%, and valuations are at the lowest years since listing at 37 times. The unraveling has also happened quite quickly from 47 times in the trailing 12 months to 37 times now, so all of this looks very good for the company. On that note, we'll wrap down this edition of All About Your Company. Thanks so much for tuning in.